Hey everyone, welcome back to our channel. Today, we're diving into a topic that's becoming increasingly relevant as more people turn to alternative ways of funding their dreams and projects, crowdfunding. But the big question is, do you have to pay taxes on the money you raise through crowdfunding? Stick around because we're breaking it all down for you right now. So, what exactly is crowdfunding? Simply put, crowdfunding is the process of raising small amounts of money from a large number of people, usually via the internet, to fund a project or venture. There are tons of platforms like GoFundMe, Kickstarter, and Indiegogo that make this possible. In North America alone, over $17 billion is generated annually through crowdfunding. But here's the kicker. Many people don't realize that this money can be taxable. There are 4 main types of crowdfunding, each with its own tax implications. 1. Donation-based. This is when people give money without expecting anything in return. 1. Think GoFundMe campaigns for medical expenses or disaster relief. 2. Rewards-based. This is often used by startups or creatives on platforms like Kickstarter, where backers receive something in return, like a product or a service. 3. Equity-based. Here, investors give money in exchange for shares or equity in the company. 4. Debt-based. Also known as peer-to-peer lending, where money is loaned and paid back with interest. Now, each of these types has different rules when it comes to taxes, so let's break it down further. Let's start with donation-based crowdfunding. The good news? Donations are generally considered tax-free gifts. But there's a catch. For these donations to be tax-free, they need to qualify as a gift under IRS rules. That means the money must be given out of detached and disinterested generosity, with no expectation of receiving something in return. So if your campaign meets this criteria, you're in the clear. However, if your employer donates money to you, that's taxable income, no matter how generous the gesture. Next up, rewards-based crowdfunding. This is where things get a bit more complicated. When you give someone a reward in exchange for their contribution, the money you receive is usually considered taxable income. Why? Because the IRS doesn't see this as a gift. It sees it as a transaction. But there are some exceptions, like if a backer contributes too little to receive a reward, chooses to forgo the reward, or if the reward has no economic value, like a simple thank you note. Also, keep in mind that if you're using the funds to start a business, those initial expenses might be deductible as startup costs, but you'll need to pay attention to the rules. Only $5,000 in startup costs are deductible in the first year. Equity-based crowdfunding is a bit different. Here, you're not getting donations or rewards, you're giving away shares in your company. The good news? The money you raise isn't considered taxable income. However, you'll have to comply with SEC regulations, which can be a whole other headache. But from a tax perspective, this is one of the more straightforward types of crowdfunding. Finally, there's debt-based crowdfunding, where you're essentially taking out a loan from multiple people. The money you receive isn't taxable because loans aren't considered income. However, you do have to pay interest, and that interest is deductible if you're using the loan for business purposes. Just remember, you'll need to pay back what you borrow, just like with any other loan. So what's the takeaway? Crowdfunding can be a fantastic way to raise money, but don't forget the tax implications. Whether it's donation-based, rewards-based, equity-based, or debt-based, understanding the tax rules can save you a lot of trouble down the road. If you're ever in doubt, it's a good idea to consult with a tax professional to make sure you're in compliance. Thanks for watching. If you found this video helpful, be sure to give it a thumbs up, and don't forget to subscribe for more tips on navigating the financial side of your business. See you in the next video.